Okay, folks, welcome to the Inner Circle Traders Scout Sniper Field Guide, Episode 4. We're going to be discussing basic infantry in this module. And what specifically will we be covering in this presentation? Well, we're going to be looking at a review of the previous episode assignment, Stalking in the Kill Zone. We're going to be looking at specific ICT kill zone examples since the time of our last presentation. It was released on the 9th of September 2013. We're going to be looking at some examples from that point on to most recently. And we're going to be looking at directional bias and high probability trade framework. We're going to be revisiting the concept of why do markets move, specifically dealing with the players and the game. And we're going to be looking at what makes trade setups strategically quote-unquote high probability. We're going to be looking at ICT no-brainer directional bias concepts. We're going to be returning to higher time frame analysis. We're going to be looking at high odds buy framework. And we're going to be looking at high odds sell framework. We're going to be looking at market structure and order flow conceptualized. We're going to be discussing and unveiling institutional orders and smart money fingerprints. And we're going to be looking at how consolidations breed opportunity and what we look for and why it matters inside those consolidations. We're going to be looking at institutional order blocks. We're going to be looking at the concept of institutional sponsorship and what effects it has on your trading. And we're going to be looking at a premise I refer to as returning to the point of origin, which is basically inside the ICT optimal trade entry concept, like a nuts and bolts presentation of why it's so effective. And we're giving you more homework. Yes, this time it'll be tracking institutional price action. Okay, so let's get going. Okay, folks, we are looking at a daily chart of the Euro USD. The last episode we released was September 9th, 2013 in this continuing series, and we discussed the likely impact that the rising yields would have on the foreign currency markets, and we discussed that it would have a continued upward pressure on the fiber, which is the Euro USD again. Real quick, let's just reflect back upon the yields and what it was doing in graphic form, and you can see that here. Okay, you see the rising yields. Okay, and when that happens, price will invariably try to chase or quote unquote seek yield, and it'll be moving up and trying to close the gap between the yields and the actual underlying price of the currency. Now, because this candle here delineates the actual time that recording was made, there's been a significant amount of pips moved from that date until now, and we're just going to use the highest point. Okay, we're not going to use the best scenario, the low. We're just going to use the highest point of that candle on the 9th. Okay, and we're going to discuss briefly the amount of pips that were available. That's 291 pips. So basically almost 300 pips were made available in advance in form of discussion as upward likely price movement. Now, we had a homework assignment from episode 3, and it was trading in the zone, okay, or stalking in the kill zone. And we're going to discuss that here. Okay, and what we're going to do is we're going to move down into an hourly chart, and I'm going to delineate the 9th of September. Okay, so everything right of this vertical line basically is referencing where we are in terms of the last recording and posting in this video series. And what we're going to discuss, okay, and as an example of the ICT kill zones, we already had a premise in mind based on the analysis of the interest rate market and how it would have a magnetic pull on price upward. Okay, and with that understanding, we're going to add, okay, we're going to add the ICT kill zones, and we're going to add the vertical day delineation. Okay, again, the double bar here on MT4 delineates weekends. What we're going to be basically focusing on is the fact that we were expecting. Now, I'm going to say this word, please don't take it out of context, because I am not a fundamental trader. Okay, as fundamental as it gets for me is interest rates. Okay, but fundamentally, the driver for the euro to be going up like it was that the yields were moving higher. Okay, and contrast that with the fact that we know that is the case when we see technically the 10-year yields declining. Okay, so if we go to the commodity market and we refer to the 10-year futures market, okay, when that market is moving lower, that's actually an increase in yields. Okay, and an increase in yield is going to be diametrically opposed, and there's going to be basically an inverse relationship between the futures price of 10-year notes and its yield. Okay, so if the futures chart on bonds or T notes are dropping, that is an increase in yields. Okay, and that's going to be bullish for foreign currencies and bearish for the US dollar. Okay, and then conversely, if you reverse that phenomenon and you look at when the 10-year notes on the futures basis or bond market is rallying on the futures market, that's going to be a decline on yields, which will be bullish for the US dollar and bearish for foreign currencies. Okay, so that's a very quick and dirty way of understanding what risk on and risk off is, how I define it. Okay, so if you're looking for any fundamental drivers, okay, that's about as fundamental as it gets from me. Okay, outside of CT data and such, and premiums on the front and nearby months in the futures markets, which we'll discuss at another time. It's too vast of a subject for me to cover in this module, but there's other resources made available on the internet that I've discussed, either my own work or by Larry Williams in that regard. So with all that, again, we were looking for bullish movement on the Euro USD and other foreign currencies with a bearish tone in the US dollar. Now, when we have that backdrop on price, okay, as a technical trader, we would be focusing on one side of the market more than the other. Okay, now that does not mean that we completely throw out every bearish sell signal. It just means that we should be focusing more in our equity allocation rather on the long side of trading. Okay, in other words, you're going to get more bang for your buck being a bull than you would be being a bear. So if you are going to be doing a trade that's counter this fundamental, again, quote unquote, driver in the marketplace, understand that number one, you're resisting the overall market pinnings. Okay, in other words, there's going to be a tug of war between you being a bear, okay, and the smart money that is really perpetuating this market higher. So understand that. I mean, there are times where you can be right and profitable, okay, in doing that, being contrary, but just don't wear out your welcome, okay, and marry the vein and just get blown out of the water. Even the best traders in the world, understand there's a simple premise: you just don't fight, you know, you just don't fight the tide, okay? Because if you're swimming against the tide, you're going to tire yourself out and ultimately kill yourself. But if we understand that being a bull in this environment, okay, we could have much more relaxation, much more calm as we engage the market because we know what it is specifically that we're looking for. Again, that gets back to differentiating yourself from the neophyte or the street money. Okay, we are not simply sitting down at the computer and saying, well, I feel like it's going to go up today. Okay, but the last 5 minutes it's been going down, so let me sell it. Okay, that's not sound trading. Okay, that's not a plan, that's reactionary trading. This whole series is delving into the importance of having, number one, a predetermined plan of attack and a predetermined method of attack, and then a procedure in place that's clearly defined, comprehensive, and you know specifically what you're doing, when you're doing it, why you're doing it, and when you won't do it, and the reasons why you won't be doing it as well. So with that rant, okay, let's delve deeper into what specifically took place from this point on and how we can use the ICT kill zones to ferret out the lows in this up move that we were looking for to unfold, how we could time scenarios where we could be a bullish buyer in this and possibly have made money. We're going to be moving into a 15-minute chart, okay? And again, we're going to be introducing the ICT kill zones, and we're going to be losing our vertical line here. That's okay. And here is the September 9th time frame, okay? And we're just going to be tracing this whole period on the upside. And we're going to zoom in, okay? And what we're looking at, again, are the red dashed lines here, okay? This basically is encapsulated the whole London session, okay? And the green in here is basically encapsulating the New York Open or New York session, okay? And what you're looking at is how, by focusing on catching a decline or pullback within that specific time window each day, with a premise in mind, where we most recently moved away from and where we're going to retrace back into. In other words, we had a range initially during the London session here. We saw it rally up in here, then it retraced within that range, the range between this high and this low. Okay, that retracement in here was an opportunity to be long as the market moved higher and expanded its London session range. Okay, we had another minor pullback. It pulled back to a dealing range high in here and then moves on out. And then we entered into the New York kill zone, rallied up, the retracement in here. While there was nothing sufficient over here in terms of support resistance, we will talk about these pauses in this video module and how it's useful to you. But price moved up, eventually moved and made a high outside of the New York session, and or at least the New York kill zone. It's not the session itself that it was outside of, but the time window that I clearly defined. Now, when you see me moving the cursor across the chart, don't be discouraged, okay, or confused because this says ICT Asian range. What I'm using is the MT4 indicator, okay, that's usually used for my Asian range barriers like we're seeing here, the upward and lower for New York. All I did was change the time parameters to encapsulate the specific New York and London sessions. Okay, so if I do pass over and you see these little boxes popping up and you're wondering what it's saying, or if you catch it and it says that, don't be confused. It's simply because I'm using the indicator itself that I named ICT Asian range. It's just it's multi useful. Okay, you can use it for different things as we're showing here. Now, this day here is Monday on the 9th, okay? Now, that was the date that we released the previous installment in this series. This is the Tuesday, okay? And now what we're going to talk about is how we use these sessions, okay, with the understanding of expectancy moving higher in price, okay? There's highs and lows within these time windows, okay? We have the low, we have a high, and in between there, okay, any swing high or low is useful. This one here, okay. Inside the New York session, okay, we have a low here and we have a high here, okay. And on the following day, on this Tuesday, this was September 10th, we have the range from here to here for the London session, and the New York session is here, okay. So inside of that, you can see that there's swing highs and swing lows that are useful as well. By understanding that, okay, and understanding the concept of the range or previous day's range or session ranges, okay, that being here's the previous New York session range. This is a low in here, okay, and what we'll do is we're going to highlight an opportunity that could have presented itself to you as a trader from that low to the high. Okay, and I'm going to move over here. You can see how price moved down into the optimal trade entry area here, which is between the 62 and 79 cent retracement levels respectively. It went right down to the sweet spot, which is essentially the 70.5 Fibonacci level. Okay, 70.5. You'll have to set your platform up if it's not MT4 your own way. I don't know how to do what platform you're using, and I really would rather avoid going through a long list of possible emails saying, "Well, can you help me do it with this platform?" I'm pretty much limited to just using, you know, what we have here, okay, MT4, because I don't want to get into, a long-winded, explanation of what possible platforms you could be using, and then we get into the conversation of which one I advise over that. So I use a very generic one, MT4. Okay, that way everybody's readily accessible. It's free, it doesn't cost you anything, and it's pretty much universal. And then you can delve into other platforms where you see its usefulness. So we did deviate outside of that range here, okay, by the defined terms of the ICT kill zones for this series. Now understand there's small variances in the times that I'm using for this one and the ones that I use for my own trading. So please don't take that comment and say, well, look at this, he's not even teaching what he uses. Um, I took a lot of time to eliminate a lot of the stumbling blocks that I see in email form, okay, because over the last 3.5 years, I have been inundated with reoccurring questions about what time window is this and what would that be in my time frame or my global position around the planet. And I readily admit it's a very confusing topic for me. Okay, so I understand it's confusing for other people, and as a mentor, that's one of my weak points, communicating that effectively. Okay, and to eliminate that, I just simply gave you a very generic time window for London and New York sessions. And if you hunt during those time windows, you'll find more than enough opportunities. Okay, and none of my tools are going to give you every single trade. Okay, um, you could probably go back in hindsight and find where it was useful to you, okay, but don't have such high demand on these tools expecting you to get every single high and low, every single movement in the marketplace. Okay, that's not what I'm teaching, that's not what I'm promising you. I'm promising you an edge, that's it. Okay, so how you tweak that edge and how you use that edge is completely and utterly up to how you employ and work at it. Okay, so on Tuesday, we saw the market make a significant low here and then rally up. Okay, and going into that Wednesday of that week, we saw price move down, making a low in London. Okay, in the London kill zone when it would be reasonably expected to form. Okay, and you could take the low from the previous day up to the highest high prior to it moving into the London session. Okay, because what you're doing is you're looking for that retracement back inside of the range. Okay, and again we see the low to the highest high here prior to it moving into the London session. Okay, price comes right down into again the optimal trade entry region, and price rallies up. Okay, if you initially missed that opportunity, it gives you another opportunity to catch a ride on this move up in the form of this pullback here. So you could use this swing low, and again let me take this off because we're already getting busy. You could use this swing low to this swing high in London, and you'll get this right in here as a retracement. Okay, and don't be thrown off also with the breaks between, again, let me show you here, the time between the London kill zone here and here. There's an overlapping between these two sessions that is very busy. Okay, there's a small little period around 5 a.m. New York time or 10 GMT where you may catch a little bit of a pause or a breather. Um, that's not guaranteed to happen always. Many times you'll see prices continue on blow through that time pocket of 10 a.m. to 11 GMT. It would be foolish of me to advise you to always expect it to be a little pause in there, but you can reasonably expect it. Treat it like a lunch, okay, where there's a small little consolidation and then all of a sudden it'll take off in the trend direction that's established by the London session. Okay, so we have a low forming here on this day, again looking for retracements to buy off of. This was one, this one in here, and then you have one in the New York session here as well. You can take this swing low and to this high here. Okay, and the 62% retracement level, and it may be a little difficult to see, so I'll do my best to draw in a little bit tighter to see that. The 62% retracement level lays right on top of that line that delineates the New York session beginning, at least the boundary about time, and then price rallied on up. I actually took this trade, okay, so it's not like it's something that's purely hindsight, and if I'm questioned or whatever, I can show you documentation about the trade and the actual real results, not a demo trade. And the the opportunity to continue moving higher in intraday in here also was available, and you could have caught some further upside as well, but that's outside the scope of this teaching and this presentation. Again, moving into, let's go out one more right in here. Okay, this was that move we were discussing, and here we have the range from the previous day's low up to the highest high, okay, right here, prior to moving into London and New York. Okay, here's New York down here. You can see how price moved to the 79-cent retracement level. Okay, and we're going to talk about why this may not have been a good idea to trade. Okay, looking for a long, because of something going on over here. Okay, but that's later on in the video, guys. I know. Teaser, teaser. Price rallies up in here. Okay, nice opportunity. Okay, just to be a buyer specifically looking to catch longs. Okay, the range available was 68 pips. You could reasonably expect to get 30 pips out of that. Okay, there's absolutely no reason why one couldn't have taken 20 to 30 pips comfortably out of that move, even with it retracing and returning back into this range here. We have a low here. Okay, we have a low in here formed, and using that to the high formed right here. Okay, price comes down, deviates to 79-cent retracement briefly, just briefly. Okay, and then gave you a little tradable rally in here to the tune of about 25 pips. There's nothing wrong with that. And if you consider the overall range of this price swing from here up to the high, and as it retraces, we had the 79 here and the 70.5 level here, respectively. And then look what come down one more time, found the 79 cent retracement level as well. One more time, bouncing off it like we did here. Just violated this low just by a little bit. You see that? If price does that, it's usually a precursor to something pretty significant. And you can see how clean these highs up here were. So you can imagine what was resting above that. You can see that was the case here. They took out all the stops with that huge weekend gap, blowing out all these highs that were way too clean. And that's classic ICT work there. You can see the results of why I say when levels are too clean, that you can expect a pocket of stops to be sitting up there, and they will gun those bad boys out. And they did a handsome job of it that week. Okay, and price moved again on Monday. Small little rally here in the London session going into New York. Okay, before a retracement deeper. Okay, now let's look at something. Okay, and it's a very cool technique, and I dubbed it an hidden optimal trade entry. And for those that aren't real fans of my work, they find it rather silly to suggest that something might be hidden and it therefore be useful, but it's really not more than simply looking at an idea of support and resistance, okay, which is what we have here. I think it would be hard pressed to find anyone that would really fight this as being a discernible level of resistance. Okay, we saw it bounce up here, here, here. Okay, and if price was to get back above it, as we see here, we would expect it to be what? Support, right? So we would have a role reversal, if you will. Okay, but simply because it's an expected level of resistance here, it may not come back down to that level anytime soon, but it still is useful to us as a point of reference, because between that level and where price opened up and rallied up to here, okay, that is a range. This right here, this point here from this candle's low to this candle's close here, this is a gap. Now, while there was no trading there, okay, you have to understand that this is still a range. Okay, that's a range. This is simply no trading between this price point of the close of the previous Friday and the opening on Sunday. There's no trading in there. It's all, the liquidity is none, zero. Okay, but because price is trading here, you still have to consider that as range. Okay, it just means that there's gaps in between these two price points, and usually the market finds a way to fill those gaps, but not right away sometimes. Okay, so what that understanding is, with this gap or without this gap, if you ever see a discernible level like this, okay, where clear resistance and support resides, if you take your fib and anchor it right from that price point and you rally it off that, take it up to the highest high, okay, when price retraces, basically what you're saying is it's retracing into this range. Gaps don't have to fill also. Okay, I've seen many times where gaps stayed unfulfilled, for years. And that was in commodity markets, that was in stock indices. Okay, just simply because the gap doesn't mean necessarily that it's going to fill. That's not a, it doesn't mean this is a common gap, if you will. Okay, common gaps usually get filled relatively quick. This could be a breakaway gap where it necessarily isn't always going to be filled. Especially if you have a long-term, monthly, yearly trend underway. Who says it's going to have to go all the way back down to that gap? Okay, this just shows that there's a huge influx of buying, okay, on an institutional level. So therefore, we still have to consider this as a range, and then price comes right down to the 70.5 and then rallies off of it and gives you what? An opportunity to trade to where? An old high. Okay, so just simply looking at support and resistance and using Fibonacci alone is useful. Okay, and there's 40 pips made available to someone that would simply understand that concept and work with it. Okay, it doesn't mean you would hold on to it and expect the moon. It just gives you an opportunity to trade. Okay, and there's a trading pattern in this that we're not going to discuss. That's been previously released by me on the internet, but that's for another time, another topic. But again, we have this low in here. Okay, that was an opportunity to catch a short-term little pop in the market. Again, focusing only being a bull. We have price moving into a larger consolidation. Okay, we do have an opportunity to see like this low here to this high. This is an opportunity here where you could potentially look to be a buyer in here. Okay, but with this gap like it is here, it's a lot of uncertainty where it may try to reach that. You could be a buyer here, and let's assuming that was the case. Price was able to move up strongly in this case here with FOMC release in here. But this day here, okay, if we use the same premise that we had that same support line, okay, let's go back just a little bit so you can see a little clearer. We're going to use the same premise. That's that support line, and we're using the kill zones again as guides. And this is the range, the highest high prior to going into the London and New York sessions. Now again, we had FOMC coming out this day, so you'd have to expect price to just more or less consolidate prior to going into that specific release. But price makes the low in New York session right on the, and I moved past it before you got a chance to see it, I apologize. Go back. Price comes right down to that 62% retracement level and then takes off. And in case you're wondering, I was long in here, and I am going to tweet the actual entry point, and you can see that I was not outside of this move. It was rather exciting because it was one of those times where we had everything in alignment. We had yields suggesting the price is going to move higher. We had a huge weekend gap that was unfilled. It just was unable to breach that 133.25, 123. I'm sorry, 133.23 level in this area here as support. Never even came down to it. Never needed to. and then just launched vertically on the upside. Again, keying off of the London Open and New York Open kill zones was useful here because the low actually formed on the day during the New York session, and price moved on higher, then went into another consolidation going into the close of the week. Again, our previous understandings in the previous videos that we see price when it rallies large like this is a big daily range. So what do you think is going to happen with the average Joe? He's going to get in the market and say, well, I'm going to be a buyer now, and I'm going to be expecting this thing to repeat the same similar move. Not always, and certainly not off of an economic report, because what will happen is there's going to be some rebalancing, okay? And what they'll do is they'll consolidate and more or less pause for a moment and reflect on whether or not this was really needed, okay? And this is very illiquid, a lot of gaps in here, okay? So it was in a rush to get somewhere, and it held this 135.30, 135.50 range, okay? And price again moving in a consolidation. Looking at how price moved like this, we are in a wait and see mode when this happens. Even though we are bullish traders, when price moves so aggressively like this short term, okay, and we're talking about a move intraday, one day, moving 212 pips in one day. When that's a huge range for one day. When you see that, okay, expect small ranges. And this is what you see here. Small ranges, small ranges, small ranges. And then what you're going to wait for is discernible signs that we have an opportunity to trade. Okay, and let's drop out because I'm a little too close. Here is that FOMC release, consolidation, a small little retracement, small little retracement, small little retracement. And then finally, we get some market structure shifting to the bullish side. And then you can see, and that what I'm referring to is this break here, this high. It made a very convincing rally, which we're going to talk about this type of price action and what is so useful about it. You have an opportunity to see this range. Price comes down to the 79-cent tracing level. Small little violation, not much, but this is an opportunity to be a buyer. Again, focusing on the time window and the kill zones. We have price rally up on out of here. So again, we have this small little range in here that is outside of our kill zone. So even though this could be a trade taken during the Asian session, again, outside the scope of this teaching, if we see this rally up here like this is the area of where you would be expected to be a long based on what we're teaching. And that looks like this. This is the low during the London kill zone and the high made during the London kill zone. So we have a price swing within that time frame. Right in here, the 79-cent retracement level. Okay, and let me zoom in. Okay, you can see price comes down. It gives you more or less like railroad tracks if you're a candlestick student. What that is you have a big range down, then a big range up immediately, and that was a precursor to upward pressure. Again, that's just using the low here. If you use the low form during the Asian session over here, you can see we didn't have anything in terms of OTE to support that except for a simple 50% fib, which is not significant in my repertoire. So again, with that understanding, you have it here, and we have this market making the high during the actual New York session, okay, and the high closing on the candle 1400 GMT. So it's 1 hour earlier than we would expect to see profit taking, which is the 1500 GMT candle, and that happens right there. So right in here is when you would be reasonably expecting to see the high had formed, and it was a little early on that day here. So basically what we just discussed was an overview of how important understanding the kill zone's role in trading. Okay, and again, just focusing on one side of the marketplace, and that's not necessarily a weakness. Okay, I get a lot of email flack about, well, you're missing all these opportunities just doing this. Well, look, man, show me a trader that's catching every move with documentation and results that show an upward equity climb. Because I'm going to tell you right now, if they exist, they're not talking to you. They're working for some big wig operation somewhere, okay? And they could care less, who on the internet believes what, okay? What we're discussing here is an opportunity to learn how to approach and engage the marketplace with a plan of attack, a trading plan, if you will. One that is repeatable, one that is usable in all market conditions, okay? But simply because it's usable in every market condition does not mean it's going to be a trade in every market condition, okay? A lot of folks are struggling with directional bias. We're going to talk about that in this video module. We're going to talk about the importance of not doing anything, okay? Because a lot of times folks will just assume that just simply because the market moved, I bet you ICT was involved in that trade. Not necessarily. My trade frequency is very small. I used to trade a lot. You don't have to trade a lot, okay? The tools I'm sharing in this video series will allow you to cherry pick. These concepts that's being divulged in this specific trading plan series is designed for you to catch those one shot, one kill weekly hauls where you're just waiting for that really good setup for the week. Make your weekly objective. Don't care if it goes anything beyond your normal expected in terms of if it's 50 to 100 pips for the week, whatever. This approach will help you do that. It'll help you get in that direction of being consistently hauling that type of that gain. If you are expecting this to give you every single day trades, you're looking outside the scope of what its intended purpose is. Now, I have approaches and techniques and concepts that are applicable for those types of environments and those styles of trading, but I don't think it's a good fit for new traders. I think it builds confidence if one can, number one, learn to anticipate, learn to engage with an understanding of why you're doing it, when not to do it, which is more important to you taking a trade, because there's more time in the market for you to lose money than there are for you to actually be in line with the market and then make money. Okay, and we're going to discuss that later on in this video. But understand that the the likelihood and the odds and time window for you to lose money is far greater than the short, small little pockets of opportunity that present themselves as trade setups that are profitable. Look, if you take 1,000 traders, pull them from all corners of the earth, put them in a room, and you tell them look at the same chart, every single one of those guys are going to have something different in what they see and what they expect. This is a framework for you to build upon. It's not a complete be all end all. Okay, it's not a panacea. But what you're going to get from this is going to give you a procedure to apply. And if it's applied correctly within the defined terms from video 1 to video 8, you're going to see a big picture panoramic view of when you should be engaging, when you should not be engaging, and when you are engaging, what specifically you're doing, when, why, how. Okay, there's going to be no ambiguity when it comes to that. But it's important for you to get through all this boring, dry stuff, because that's what gives you the understanding to make you effective once you start applying these tools. Because every time you watch these videos, it doesn't mean simply go out the next day and expect those things to unfold exactly as you saw in that previous video. You learn by expecting to see similarities to what you see in these videos, and you gain a understanding, okay, and you activate your reticular activator system where you start seeing the same pattern unfolding all the time, always there. And there's going to be slight deviations from what you expect to see and what actually is there. And that's the fine art in trading that you aren't going to learn from a textbook. You're not going to learn from a $2,000 webinar, seminar, going across the planet to go see somebody that promises you he's been doing it for 25 years and he's so much better than everybody else. Look, there is going to be a growing period for you, and it's going to come with being in front of the charts. I learn something new every single month. I'll go back over my journal, and I will discuss about how to keep a journal in the last portions of these videos, and what's a real good way of referring to it, reflecting on it, and what you should be gleaning from every time you do it. I learn something new, and a lot of it's about myself, not necessarily about the marketplace, but I learn a lot, and I journal those types of things. So when you see these kill zones, learn to anticipate specific types of price action and behavior. You are not at the point at which you are expecting to do trades yet. Okay, you're still in an observatory state. Okay, what you're doing is you're spectating or paper trading. Okay, you're just looking to see how these markets gyrate and move within these specific time windows with a higher time frame, panoramic, quote unquote, fundamental perspective. And I'm hoping that you're gleaning that there is a few cherries hanging on the monthly tree of Forex, okay, that you can calmly and gingerly walk up to it, reach out and pluck those cherries when you know it's applicable for you to do so. Not simply because it's an opportunity to trade, because therefore it's Monday, the markets are trading, I got home from work early, or I'm going to bed early, I'm going to get up and be up in London, therefore I'm making time to be in the market, so I'm going to take that trade. There's not necessarily a guarantee anywhere that your trading opportunity in terms of time and freedom isn't going to line up with the market dynamics that you know propel the market up or down in your favor. So it's important that you understand that, okay? And these kill zones, while they are absolutely dynamite in the right hands with someone that understands what should be transpiring, and a culmination of all these components together, by themselves, they're absolutely going to be useless to you. Okay, they're just highlighting a window of time where things generally happen. Okay, so don't expect them to do anything more than that. But go back at when look at when the windows of the kill zone of London and New York present these tremendous opportunities for you to be involved with being in that marketplace with that dynamic in mind. Like we had from September 9th, we expected the market to move higher, we expected the dollar to move lower, we understood that fundamentally, quote unquote, based on interest rates, okay, and that magnetic pull it will have on prices in the currency market. And you saw that unfold here, not necessarily just simply in the euro. It happened in the cable, okay, it happened in the Australian dollar, okay, it happened in all of the foreign currency markets in contrast to the US dollar. Okay, folks, we're going to be looking at directional bias framework. And before we get into the specifics, um, I want to ask you a question. Okay, and we kind of visited this earlier on in the video series, but why do markets move? What propels markets higher and lower? Is it the average retail traders like you and I, or is it going to be the large institutional banks and investment firms? Those entities on the larger scale, obviously, beyond the shadow of a doubt, are the catalyst for markets moving higher and lower because their sheer volume, uh, you know, requires price to move based on the supply and demand factors that they create by their mere presence in a specific asset class. And it goes without saying that if a currency is undervalued and for whatever reason the large institution seems to believe that it's undervalued and it's going to appreciate in value, without doubt they will try to accumulate that currency. But because their volume level is such a great uh, contrast to what we see in a retail side, they leave a very big footprint. Okay, and I use the analogy in this video series. It's like the elephant, getting in this children's pool. Okay, this the displacement of water. It can't be missed. It's obvious. It's when they enter, you can see there's a major shift in price. Okay, they don't sneak in. They don't, you know, All of a sudden, hey, look at that, this 500 pip rally just took off out of nowhere. Where did this come from? If you understand what an elephant track looks like, you'll know what happens in the future when you see them start to materialize in price action. Okay, it's a rather simplistic way of looking at it, but the main thing you need to understand as a trader is that you are not going to muscle this market. Okay, you're not going to be the catalyst for it to move up and down. Okay, the collection of us, the retail universe in trading, will not move this market. Now, we may cause little minor blips, okay, on the very, very short term, okay, but by far and large, the currents in the marketplace are always going to be dictated by the larger predators, okay, and those entities are what we considered quote unquote smart money. And because they have the sheer volume behind their trades, they can manipulate the marketplace on a certain time frame. Now, the long-term trends obviously are a result of these larger institutional smart money investors and trading banks. They keep momentum moving in one particular direction or the other until something changes it, either fundamentally or technically, that prevents them from wanting to uh, participate in that existing trend. And then that's what will happen is you'll see a market shift. There'll be a pause maybe, or an abrupt reversal altogether, and a change in market tide. Your job as a trader is simply just get involved with what those smart money traders are doing. Okay, and we're going to be dealing specifically with that type of mindset in this section. And the next section after this, we're going to be dealing with a lot more specifics in terms of how to trade with the insights that's gleaned with smart money action in the candlesticks and in the overall price action of whatever asset class that you trade. And because this is an ICT concept, it's universal. It's applicable to commodities, it's applicable to stocks, energies, crude oil, metals, gold, silver, palladium, platinum, copper, yeah, and as well as debt instruments like the bond and T-note markets. So don't think this is only going to work in Forex. It's a measure of understanding how to read institutional ordering and the order flow that's apparent in price action, and it does not require um, a dependency on indicators. Okay, so it's a leading indicator, if you will. It does not lag. Okay, so in other words, you're going to see the future in what I'm sharing with this concept um, versus what you would glean if you were just using a stochastic or a MACD or whatever indicator you like to use. Okay, so it's a forward-looking approach versus looking at old data and crunching it mathematically to arrive at whatever you come to believe is beneficial with indicators. All right, so what makes a trade high probability? Okay, in other words, strategically speaking, when you hear mentors or traders or authors or whatever it is that you pay attention to, or even me, when I say this is high probability, what deems that setup high probability? Well, the simple fact is it's generally in sync with what the higher time frame market charts are telling us, and also with the current market environment. In other words, is it a risk on, a risk off? Is it moving in the general tide of what the higher time frame markets are doing? Because again, we understand that these large animal predator, these elephants, if you will, when they enter the marketplace, they're going to push price around. And again, think of that analogy. The the price of the asset class, and we're going to stick with Forex in this example. Assuming for this example, we're looking at the fiber or your USD pair. For the market to rally, as we see here in the early part of July, up to this point here, okay, that's not coming by way of retail traders. Okay, now that does not mean that retail traders cannot be a part of this move. Okay, but the catalyst was certainly not, originated by the retail universe. Okay, that was clearly the large dominant players in the marketplace. But there are certain clues that are left in the chart that's very clear if you understand what you're looking for and how you can use those moving forward. If we understand that our trading is in sync with that mindset, that's what causes us to qualify or quantify the trade as high probability. Why is it high probability? It's because it's moving in the general tide that's been established by the larger dominant institutional trading. So if we are in sync with that tide, or if we're in sync with that market momentum, okay, we are not trying to be contrarian in regards to fighting the strong arm smart money traders. Okay, they're going to take the market where they want it to go, regardless of how many indicators you have on your chart, whether it be your electronic little trading programs that you created and typed up, and maybe you bought it on the internet and it's made a lot of money in the past. Those absolutely are worthless unless they're in sync with what the large institutional traders are doing. Okay, and the only way you understand what they're doing is by price action and leading indicators such as we're going to discuss in these next two sections. And I promise you, you're going to jump about 20 light years ahead in terms of what you're understanding in price action and prognostication in terms of technical analysis. Okay, that's a promise, a guaranteeing it. Okay, so now let's take a look at the ICT no-brainer directional bias concepts. Okay, and I say that with tongue-in-cheek because I've been asked so many times about directional bias and how do I get it right more times than wrong in terms of where the direction of the market's going to go, either be short term, intermediate term, or even long term. And it's simply a matter of understanding higher level charts, support and resistance, price action, and the overall tendency that the market will continue to move in one direction or another until something of equal or greater that may cause a break and shift the tide on the higher level charts. So if you have that understanding, every little minor move on the intraday charts, okay, are meaningless in regards to higher time frame unless you understand how to apply them. And what do I mean by that? We'll use this rally from here in July. Okay, from the lows made here in the fiber, again, Euro USD is the daily chart. As the market moves from this point here, okay, and we're just going to quickly identify the ranges here. Okay, this point here, and I'm just roughly just dropping it. It doesn't have to be the exact. We're just talking about a specific move in price. Okay, from around the 127.57 low to 134.50 level. Okay, that's a pretty significant means of movement between one point to another. Now, in terms of pips, we're talking approximately almost 700 pips rally from there. Okay, and we were talking about the cable and fiber making a low back in here, both this point and this point here. So this is no surprise to us in terms of ICT concepts. If you go back on YouTube, I actually talk about the cable actually making the very low well in advance based around some of the principles we're going to talk about here, and also I'm going to build upon what's already been released in my previous works. So now, if we understand this has been established, okay, this price move's been established by the large institutional smart money traders, okay, those that have huge blocks of trading that will push the market all over the place. It does not mean that there's not short-term selling opportunities in here. Okay, I'm not negating the effectiveness of short-term or day trading contrary to the larger time frame. I'm not saying that. But this series is really designed to get you focused in on only trading with this tide. Okay, and when you start trading with that, it's same thing here from this high to this low. If you were looking for just shorts in that environment, your trades number one are going to be quote unquote high probability because you're trading in sync with the higher time frame macro perspective, okay, because we're looking at a daily chart, and this flow, okay, of orders moving lower, okay, is going to drive pricing lower. Even though you'll see these minor little blips going higher intraday, okay, those are rallies that you sell into, much in the same capacity on the flip side of that. All during this point here, any decline just sets up a retracement in a up move. Okay, so you're going to be trading retracements lower into a upswing in price. Okay, so you're basically buying dips in a rally and you're selling rallies in a decline. Okay, so as the market's moving lower, you're going to be looking for rallies to sell into. That flies in the face of what generally neophyte traders anticipate or expect to do, rather, okay, or react to, okay, because generally retail neophytes don't have skills to anticipate. They simply react. An economic report come out 5 minutes ago that they had no idea was coming because they never pay attention to the economic calendar, something that a seasoned professional will always consult prior to the week beginning. In fact, I know what's coming, for the entire month, and I have certain dates that I circle where there's going to be high probability volatility. Okay, because I view market economic indicators and reports that come out, methodically out throughout the entire month. These reports, okay, are injections of volatility, and I look for them to set up or confirm a continuation of an existing move I may either be a part of or looking to be a part of. So I'm anticipating versus what the neophyte traders do, and majority of the folks that populate these online forums that where they appear as if they may be convincing other people that they're smart or they're intelligent or they have a service that's useful, so therefore I'm going to sell for $25 a month or $120 a month or whatever. Okay, those individuals, okay, they are nowhere near the degree of trader that you are looking for. You want to go beyond that. Okay, and to get in the realm of what we consider underground traders like myself, or folks that are just really out there killing it, and we don't really care who believes what we're making. We don't care about that. You want to get to that same mindset as well. Okay, and the concepts that we're going to be learning in this particular video itself is going to be hugely impactful to your trading if you apply it correctly. And it's very, very simple procedures. So I'm pretty confident that it won't be taken out of the intended context of how to apply it, because it's rather simple. But my advice to you is try not to build on this and add more things to it, because we're going to be talking about candlestick patterns, okay, but it's not a whole slew of them like you see if you pick up a candlestick charting book. Man, there's so many candlestick patterns. How do you how do you arrive at what to use? Okay, and it's just too much. Okay, it's information overload. Prior to this video series, I presented a whole plethora of general market insight because it was meant to get you focused in on what specifically is useful when you're digesting price as it's moving intraday, daily, weekly. You want to be seeing certain things, and until you identify the repeating reoccurrence of certain phenomena that takes place in price, you can't get deeper into price action study. Okay, imagine how many of you can speak Russian. I can't. So for me to learn it, I got to go through this long, daunting task of understanding how to use simple terms and maybe even some mannerisms to communicate that language in the initial stages. It's almost like when we were in kindergarten as an American, when we learned English, you start with these picture forms. This is an apple. You start with a very, very you know limited scope in terms of understanding, and you build upon that. Well, the original onset of my information being released, it went over a lot of people's heads because they were looking for the get me in, get me out, and I need to do this every single day. And they didn't want to take the learning approach to understanding the market completely. Okay, there's got to be a macro perspective in your understanding. Otherwise, the things that we're going to be discussing here, okay, you're going to know if you got a full grasp on the general principles that I've released. Because if this goes over your head, you had no idea what you missed. Go back over all the previous information I released on the internet, okay, and then you'll be able to understand what I'm about to share here. Because it's just simply not looking for a particular white or black candle, and therefore it's going to do this every time it does that. Don't think that, okay. But if you understand the parameters that we're going to cover, and why it's designed to do what we're anticipating, you'll see that it's not a surprise. You'll know going into every week of the month that you know exactly specifically what you're looking for. You know what days of the week you're going to be looking for it. You know what time of that day you're looking for it to occur. Now, does that sound like someone that's rolling the dice? Does that sound like somebody that really doesn't know what they're doing? Okay, the skills that you're going to learn, okay, are going to give you the ability to remove all of the emotions that's always plagued you. Okay, and I know some of you are beating your fist on the couch probably, or your computer desk at work, whatever. Come on, ICT, get to it. It's a whole lot of ramble here. Okay, but I really want you to understand that it's important, it's crucial that you understand that this is not needed to be rocket science. Okay, if there's a lot of tools that I've shared, I've tweaked, that other people have created. I have my own little spin on it. But some of these things that are just simply there, that are very, very generic, okay, they elude all of this. And when I first started looking at charts, it eluded me as well, okay? But I'm going to strip all this stuff back. I'm going to open the curtain, if you will, okay? And you're going to look through the eyes of ICT, and you're going to have ICT vision, okay, starting now. I'm going to give you the perspective that you need as a professional trader. I'm going to give you the perspective that you need to see price through the lens of a price action trader. This is what you want to be looking at, and what you're hunting, and what you're stalking, and why you're doing it. Okay, so let's go on and start working on the directional bias concepts. And hopefully you guys are all frothing at the mouth, ready to devour what is going to be shared here. Now, there's going to be a very similar appearance to a few of these concepts, because I've released videos in the past where I discovered, by simply applying a moving average or two, it gives me a perspective to stay with a momentum idea. Okay, and that's generally how the funds and the institutional traders, you know, keep the momentum going, and it keeps you from trying to pick a top and pick a bottom when there's really no need for you to be doing that yet. Okay, um, what you want to do is you want to start with your daily chart. Okay, again, this is an intermediate term trading strategy where it really is focusing on one really strong setup per week. And again, if you're a new trader, that's my advice, is to start there with your demo account trading. Don't try to be in there every single day trading, but still study on an intraday basis daily after the fact, so you can get an idea of what price action is doing generally. But your your daily chart is your higher time frame. Okay, and again, we're not negating the importance of monthly and weekly support and resistance, but we're just going to be going to the daily chart as our go-to high-end higher time frame chart. Okay, and go over the videos previous to this one where it discloses what time frame charts you would use for particular type of trading that you may be comfortable with. All right, so again, with the daily chart, what you're going to do is again, using the MT4 platform, you just go up to Insert, you go to Indicators, you're going to go down to Trend. You're going to go to Moving Average. And you're going to be using the 18 period moving average. And it doesn't matter really what colors you use. We're just going to go with this. And then you're going to go and add another moving average. Okay, and make sure it's exponential. It just, to me, it just gives you a better smooth factor in terms of the moving average. In the next period, you're going to be using a 9. And you want to have this color a little bit different, so we're just going to go with red. Okay, and again, the colors are not important. It's just you want to know, for instance, the red one here, the 9, you want to know what that color is in contrast to the slower 18 period exponential moving average. Okay, now the importance of having a moving average set like this, what it gives you is it gives you insight in terms of where the institutional flow is. Okay, if you can't see the price swings for what they are naked, this will give you the, again, quote unquote, no brainer. Now again, it's not to promise that you're never going to have a losing trade. That's not, I don't promise that, no one ever can. But what I'm giving you here, you will not miss the 2 to 4 really handsome setups per month. Okay, and if you just do the simple math on that, that works out to be about a one shot, one kill per week. That's all you need to make a career. And I'm talking a wildly successful trading career. And I know that flies in the face of what you're expecting or what you currently understand, but I'm promising you, if someone consistently draws 50 pips every single week out of the marketplace, if you know how to do that and you can control your equity and know how to apply it, systematically, you have absolutely no idea where that can take you. And it's crazy amount of money, crazy, crazy, insane amount of money if you understand how to do that. But the problem is, you made a simple trade last week or yesterday, and you love that feeling. Okay, you get addicted to that moment of astonishment. Okay, so you want to go back in there and do it again because you like that feeling. You need your fix. That was the hardest thing for me to overcome, and I'm promising you that's going to be the hardest thing that you're going to have to deal with, because when we first get involved, we can expect to lose money. Okay, and for whatever reason, we like to block the losers out and only focus on the winners. But you need to be able to look at them, the same way, their trades, and you need to learn from them. But more importantly, when you make money, okay, you need to act slow when you're trying to make money, and then act fast, okay, or react fast. This is your only time you get permission from ICT to be a reactionary trader. You react quickly to preserve or protect your equity or capital. You move slowly to attempt to make money, okay? Fools rush in where wise man treads softly and slowly. Okay, we don't plunge in there trying to just go in there and try to make the next dollar. I want to know what I have is lined up with the higher time frames. There's a nice support resistance level, momentum's moving higher, order flows moving higher. Then I'll be looking for a long, okay, in a kill zone based on the retracements back in an existing price swing. And we're going to talk about that as we go along. But for now, the building block starts with having the two moving averages right here. Okay, when the 9 period moving average is below the 18, what that establishes, that's your framework for when the 9 period, or in this case red, moving average is below the blue 18 period. Okay, that establishes a bearish framework. Okay, in other words, or I like to call a sell model. Okay, or sell program rather. And what that does is it gives you the green light go to look for selling opportunities to be a bear. Okay, or you want to be selling into rallies. Okay, and when the 9 period is above the 18 period, what you're looking for is buying opportunities where you want to be buying a dip, okay, intraday or over the course of a few days if you're a short-term trader. As we make a retracement lower, okay, all that's doing is it's creating a new buying opportunity. Okay, and that's what keeps you on the right side of the marketplace, and you arrive at what was discussed a few moments ago, what classifies a trade as high probability. This is high probability, okay? And what I want to draw your attention to in here is, again, avoid the notion of having to feel like you have to pick the tops and the bottoms in the marketplace, okay? There's tools that I have that helps you do that on a higher time frame macro perspective, but we're looking at more dynamic trading. This will allow you to get into the trenches, immediately start applying the tools, okay, on a weekly basis, and then hopefully in your demo account you'll see the fruits of your labors. But also, I specifically chose this time frame because it will force you to not overtrade, which is one of the biggest, huge barrier for new traders. Day trading is not everyday trading, okay? And I'm not teaching you day trading here. I'm teaching you high probability, one shot, one kill them hard. I mean, just knock them dead type setups, where if you just sit back and you wait for these types of setups and you're demonstrating, you'll see a huge increase of your confidence, your understanding of the marketplace. You will hone your patience. You may not have patience now, but using the concepts in this series, you are forced to hone your patience. Okay, a lot of folks that I've been in contact with over the last few years because of my presence on a particular market forum, they have struggled with patience. They have struggled with these these demons, if you will, internally. So I'm forcing you go back to this type of perspective. Okay, and number one, it's going to limit your excess trading. It'll take it down a huge notch. Okay, because you're only going to be trading at maximum, a few times a week. Okay, depending upon the kill zone and the setup, and you're forced to have a larger perspective in terms of your analysis. So really, the worst case scenario I think that a trader would have would be maybe 12 to 14 trades the entire month, and that's still in my opinion that's a busy trader. I know some of you guys get in there and 5 or 10 minutes and you catch some 5 or 6 pips, and that's wonderful. If that's what you do, that's wonderful. I just think that's just crazy, but I used to do it and it doesn't pay off the amount of time you put in. If you have this perspective, you're going to see it blows it out of the water, and I'm not spending a whole lot of time in front of my computers. Okay, and which is what you want to be doing too. Professional traders don't live in front of monitors. Okay, they don't do it. Junkies do. Okay, action hounds do, and they may do trading for a living. Okay, but I'm promising you, they're on edge all the time. They're probably dumping gallons of caffeinated drinks in their body, okay, and high sugars, and it's just their health probably really stinks in terms of not being a part of the real world away from these charts. So this is going to give you that ability to do that. So we already identified when the parameters are in place for a selling framework, okay, when the 9's below the 18, and when the 9 is above the 18, that's the framework to be a buyer. Okay, again, do not do not worry about catching these turning points. Okay, don't worry about that, because what I'm allowing you to do is you're going to run into where your trading stops being profitable, and you'll have to, number one, adjust your equity. You'll have to calibrate your risk to reward. You'll have to calibrate your leverage based on your equity decline. Okay, too many folks overlook that. Okay, and this is going to force you to do those very things. Okay, professional traders and money managers, we do that always on a daily basis. We're always looking at what we're risking, what we stand to make, and how are we going to remove that risk to zero and then lock in a profit. That's where the majority of my analysis is. It's not looking at charts and waiting for the buy signals and the sell signals. That's the easy stuff. The hard part is knowing that the market's predisposed to go higher, and then fighting that urge to risk 8% of my account, 20% of my account, because I see this stuff happen all the time. You reasonably expect it and anticipate it to unfold, but there's no guarantee it's going to. Okay, so I'm giving you these skills, okay, to work with and give you a mindset that hopefully will guide you to consistency. So let's look at just a brief sample set of how this is applicable. We're just going to go and scroll through just briefly. Okay, and we'll start here. Again, I don't want to go back too far because we could make a huge you know treatise over this whole thing, and really not get to the other things that I want to cover. But we have the 9 period break below it here. Now, price can stab through both of these moving averages. Okay, that's not important in here. The important fact is that if the 9's below the 18, your mindset is I'm looking for sell scenarios. I'm looking for rallies to sell into. Okay, and you can expect the blue line or the 18 period, okay, to act as like a dynamic support and resistance level. Okay, I don't like trend lines. I don't have faith in them. Okay, but when you have a moving average like this, it allows me to anticipate price reacting, and it's a very nice example of it here. Okay, a nice example of it here as well. And the bodies of the candles remain below the 18 here. So even though we did have some wicks stabbed through it, the body itself was unable to close above and then remain lower. And you can see that the result of the market action was going to the downside. So when you have that in place, okay, when you have that in place, it allows you to, number one, view the market with a higher level institutional momentum perspective. Okay, and that's a whole lot of words there, and I'm not trying to be wordy or sound intellectual. I'm trying to communicate the understanding that I have in the marketplace, because I can't, if there was a resource for me to say, hey, go to this book and this is what it teaches you, I would have saved myself a lot of trouble. But there's no books out there that I'm aware of, and I have a huge library of it. So this is the way for me to create a language or a vocabulary for us to interact so you can understand the concepts. Okay, so when we have the 9 period above it, above the 18, we're buying, and when the 9 periods below the 18, we're selling. Okay, that by itself will get you into a whole lot of wonderful, sweet spots in the market where you can just take these opportunities and be happy with that. But because I'm ICT, that's not enough. Okay, I got to take it to the nth degree, and we're going to be looking at how we can further amplify the effectiveness of directional bias understanding. With now, we're going to look at a series, okay, of we'll just use this little area too. Okay, and here that was a buy area. From this point in here to here was a buying area, and right in here became a selling framework where you're really just focusing on being a bear, and we'll just use that because that's a nice little price swing in here we can work within. And what I'm going to do now is I'm going to take the moving averages off, because we've already established where the averages have communicated the bullishness or bearishness that we should be focusing on. Okay, so now with those moving averages away, we're going to apply now market structure and order flow, okay, and or market flow, whatever you want to call it. But the premise of where swing highs are taken out to the upside, okay, that is momentum on the upside, in addition to when you have these little areas where market is generally looking to move higher or lower based on these two components blended together. And what I mean by that, well, we're going to go up to the indicator thing here on MT4, and again, I do not require a 5-day or 5 candle pattern to create a fractal. Okay, and when I say fractal, it's this little thingamabob that's on MT4, and I probably should have used a different color, which I'm going to do now. And we're just going to use we'll use red. That'll pop off pretty good. All right, in here we have a fractal high, or basically a swing high. In other words, it's a candle with two lower high candles on both sides of it. For me, in my trading, I simply use this candle with the higher low here. I'm sorry, with the lower high here and a lower high here. Okay, between this pattern, this candle, and this candle, that alone would have presented a swing high to me. And if that was violated on the upside, that would have been enough for me. Okay, we have a swing high here. We have a swing low here. We have a swing low here as well. Now, as price moved above this swing high here, right there, now we have both swing high broken out, or market structure has shifted upwards, while we're in an area where those two moving averages are implied momentum is bullish. Okay, so from this point on here, we are looking to be a buyer. We're going to be looking for a retracement of some sorts, okay, to be a buyer in. Okay, now you see a minor little retracement in here, and then it rallies off. Now, even though we have a bearish candle here, okay, we did move higher. Just in terms of pips, from the time it broke this swing high here, we're going to use that range to the high up here. That's 179 pips. Okay, 179 pips. That's inside of 1 week. Do you think you can get 50 pips out of that? Is it reasonable to think that one would be able to? I hope you think that at least. Okay. Again, we have price still above this swing high, and the only recent swing low prior to that point is here. So as long as price doesn't break that swing low, we are still bullish. We have a swing low form here, but notice that that's the only one since this one was formed. So market structure and order flow suggests that we are still go for buying opportunities. Okay. Now price retraces again, okay, inside of this range. And we broke this swing high here. So when that breaks, this is the range right here. This is that little price move here. If we looked at just that range alone, again, we're working on a daily chart, guys. This is not an intraday chart. If I look at using the fib, I'm trying to draw it so you guys can see. Here's the 79-cent retracement level right in here. Okay. Now, true, it violated just a little bit, but ultimately it spent very little time, okay, blowing through it, going on the downside, and then we moved higher again. That by itself is insightful because number one, it allows you to understand where these fractals are forming, okay? And I'm saying fractal in the sense of the price pattern, not these little arrows, okay? And that's probably confusing. I wish they would have named this indicator for these swing highs and swing lows as something different, but Bill Williams, for whatever reason, felt he needed to call it that. And it's not a fractal by my definition, or many others if you really looked around. But we have a price rally from in here up here. Now we're going to talk about how this could have been viewed in advance before this happening, where over here something goes on that's useful to tell when there would be an opportunity to be a buyer. But before we get to that, here's another opportunity just by using the range. That's 130 pips from that point to here, again within a week's time. So there's plenty of opportunity to be profitable, okay, and catch your 50 pips or so a week. And again, I'm trying to give you a realistic low end objective that flies against everybody else teaching that you got to make 2,000 pips a month, okay, because you don't need to do that. And my question is this: if these guys are making 2,000 pips a month, okay, or 20,000 pips a year, why aren't they billionaires? Think about that. Everybody's selling courses. Why isn't there a billionaire out there? Okay, because it's crap. Okay, look, you can have a million pips all you want. It's how much you manage your money behind those pips. Okay, and I guarantee you, 99% of them don't do right things with their equity and their money. So just simply because you're showing me a spreadsheet or you have a video on YouTube saying you made X amount of pips, it means absolutely nothing to me, and it shouldn't mean nothing to you. Okay, so again, think you don't need a whole lot. So if we're going to focus on just on 50 pips a week, that's a realistic, obtainable goal, and it's something that could be duplicated over and over and over again. It's like a cookie cutter approach. You keep doing the same thing over and over and over again. Sometimes you run out of dough. Okay, and what you got to do? You got to ball it up and work it out again. Spread it thin, spread it thinner. It means risk less. Okay, cut back your equity. Okay, and then you keep doing that same thing. Milk it for all it's worth. Doing the same thing. Don't deviate. Don't change the parameters. And then by approaching the market like that, number one, you're not going to be surprised when you lose money, because you're going to know that, okay, that didn't work, and I'm not going to be jumping back in again because my system or method or parameter says that I can't. So I'm limiting my exposure and my engagement to the marketplace to just this. Okay, which is hugely important because 90% of traders don't do that. Okay. Now, even in here, now this is why I don't like candlesticks, because it's very deceiving if you are looking at price action on a specific manner. And then what I mean by that is this: we have a low here, okay, and if you look at the range between this low of this candle to this candle here, we have a price swing. Okay, if you looked on a lower intraday price model, you'll see that this is a very nice price swing. Okay, it's disguised many times because many many of you folks don't even look at a daily chart, but this here is a range. Okay, this is a tradable range. If you look at what was available from that retracement, okay, again, cancel the idea of this being a bearish candle, this a bearish candle, and this a bearish candle. Price moves from this low to this candle's high here. It's 123 pips. Again, that was made during bearish candles. Okay, even though the market did come down here, I'm not ignoring the elephant in the room here, if you will, on this 2 or 3 day down move. I'm not suggesting that didn't occur or wasn't significant. What I'm stating to you is if you stick to the model of looking at the low to high and then retracement during an ideal time frame, okay, notice we didn't break this swing low that formed here. We came down into the range between that candle's low and this candle's high. If we use our fib, okay, pull that up. Okay, we have a reasonable idea where to anticipate, again, where the low should form. Okay, and if you looked at, and I'm probably splitting hairs, but I really want to communicate this well. We're only talking about 11 pips from where the 79-cent retracement level is and where the actual low that candle formed. Okay, so again, when we get to stop loss placement and overall risk controls, you're going to see that there's simply no reason to fear where you should be placing your stop at. Okay, there's no reason to guess as to am I going to get stopped out, and fearing it also, because if you get stopped out where we're going to teach you, you need to be getting out of the market there. Okay, because it's probably going to be much more of a move in against you than if you were to stay in it. Okay, so we have an opportunity to be a buyer here as well. The market comes down, creates another consolidation, and then moves out of the consolidation. Okay, and the market structure and order flow shifts bearish here when we trade lower right there, because we broke that swing low. Now when this broke down, okay, we have to wait for another shift in market momentum. Okay, and this is the reason why I do not like this little fractal indicator. Okay, because remember I told you earlier that all I require is 3 bars or 3 candles to create a swing high. That's occurring right here. Notice there's an absence of a fractal arrow like it does here. That's because this big old candle here, okay, its high was above this candle's high, which would negate the formation of this arrow, or an arrow like this, a fractal up arrow, because the parameters require this candle to be a lower high than this one. But is this not a swing high? Yes, because it has a lower high on both sides of it. Okay, so this is a swing high. As soon as this candle broke here, we're back on the bullish momentum. Okay, and then we entered this range here. Okay, we started another series of days where those 2 moving averages have the 9 above the 18 moving average. So that we're in a bullish framework when the market structure is bullish. Okay, because again, we see this swing high here when it broke to the upside. Now we have to wait, okay, and expect to see the 9 be above the 18. Again, we're looking at a daily chart. During this time period, what you're going to be looking for is opportunities where price again finds support, pulls back within a range, okay, either on a 4-hour chart or a 1-hour chart. And when you see what we're going to be talking about later on in this video, what you're specifically looking for and hunting, 90% of the time it's there, and there's no reason for you to rush to chase price. If it doesn't do these types of things, you don't take a trade. Okay, so again, we're looking to be a buyer here, and all of the ranges in here, again, with all these candlestick patterns, you could have all kinds of articles and such. Oh, these are the spinning tops. These are the the dojis and whatever you want to call it, the boxcar willies. I'm not a subscriber of a plethora of candlestick patterns. Really, I like the dojis, long-legged dojis, the hammers, and I like railroad tracks, and that's about it. I don't have any other faith in any other pattern. So you can kind of like leave that in your notebook. Don't ever ask me about candlestick patterns outside of those, because I don't subscribe to the views that they're useful. Okay. Now, on the daily chart, we have the highs in here. Okay. And look at the bodies of these candles. You see that? This is where I like candles. Okay, these are the ideas that I think are beneficial to using candlesticks. Do you see how this dealing range level, okay, if we take that out, see how the bodies of the candle here, the opening was at that level, the close of that candle was at that same level, the opening was just a pip below that level here, and the close of that candle was, I'm sorry, I've been saying that wrong, sorry. The close of this candle is on that, and the open on this candle is at that same level, and the close of that candle is just a pip below it, and the open on this candle is right at that same level. Do you see this candle here? Okay, after we had a little minor retracement in here, okay, we had a retracement. This is the range because we have this dealing range here. When price broke through it, okay, see how this is a swing high and see how this is a swing high? When price broke through it, market structure confirms once again that it's on the upside, okay? But we also have this dealing range support. So we broke through this. Now, just because this would be classified as support level, an old resistance turned support, does not mean that price needs to get all the way back down there. Okay, so how do we use that information? Well, if you pulled your fib from that level up to the range high, which is here, okay, that candle, because we pulled down intraday, okay, inside of that range, you come right down to that 70.5 level. Okay, do you see how that's useful to you? We retraced within that. So having that gives you an idea again where to anticipate price action to retrace into. That's not all of the characteristics we look for, but we will be looking at other things that allow us to break down on a 4-hour chart where we can also look for institutional order flow to support the idea and the notion that we should be expecting higher prices. And again, we move higher and higher and higher. The higher swing lows here, okay, again, are higher in each successive move higher, okay, and then we see market structure break down in here, okay, and we did rally off again in here a little bit, okay, while we're in this green buy framework where we overall would still be looking for opportunities to be a long trader. I want you to see the low here or this low here. Either one, they're very close in proximity, but we're just going to use this one here. If you look at that low up to this high, okay, you see that? I'm going to move the fib over here so you can see the lines. There we are. What I did was I used the range of this low to this high. Again, this is a daily chart. Price comes right down into what level? The 79% retracement level. Look how many opportunities where price stayed within that optimal range, okay, and it rallied up. If you look at where we were in regards to that price movement, again, using these bodies of the candles up to the high of this candle right here, that's 156 pips. Again, 156 pips within a few days. That's inside of 1 week's range. There should be no reason why you can't capture at least 50 pips out of that. Okay, the opportunity here. Okay, the bottom line is there's opportunity for you to make money and still quote unquote be wrong, because ultimately the market did move lower outside of this area here. Okay, and then we moved into a selling framework. Okay, you have the market breaking down, making lower lows, okay, and lower highs. So we have the swing high here with a fractal. Now I got to change this fractal to a different color because it will not be seen against the red. So we have this fractal low here. Price breaks down through it, again confirming that we are in both concepts agreeing with lower prices. We have the two moving averages. The 9 is going to be below the 18. Remember when we marked out this box, that was giving you the bearish framework to expect lower prices. Momentum wise, institutionally, they're going to be looking for order flows lower. Okay, and you see technically they are moving lower because we see the swing low here break down. Okay, so when you see that happen, what you're going to be doing is you're going to be looking for the ranges, okay, to form. You're going to be looking for rallies. You're going to sell into those rallies. See this low here, and we see the price actually move up here. This high down to that low. Come to the 62% retracement level, okay? And again, we're going to discuss a concept that is useful in terms of institutional order flow, where we can again identify areas on a lower time frame where this is again one more area where order flow and short-term market structure shifting, and where institutional order blocks are retraded into to get another piece of the pie, if you will, before they start to move lower. You can see when the market moved up into that range, it did not spend a whole lot of time there, and that's why you had this very thin wick. Okay, the market opened here, rallied up, and then traded lower and closed lower, and that creates that black bar. Okay, the close is near the low of the day. You can see the close on this candle is 130.64 with the low at 130.47. Okay, as price moves lower, it breaks each new successive lower swing lows, and each swing high is lower as well. Now we have again an opportunity where the market creates a swing low here, trades lower, okay, and it comes back here and takes out this swing high. Okay, that's going to happen a few different times while we are in trending environments, because again they're going to come back and take the stops and search for liquidity. Whenever you see swing highs like this on a daily chart, naturally that's where support resistance is going to be implied by traders, and they're going to think that their stop loss orders are protecting above that, and you'll see the market rally up there just above it, take it out, and then break lower. It still does not change the fact that we still are working within a range, okay, and that being this high to the low. And if you look it up in here, you'll see opportunities to be a seller on the lower time frame. Again, uh, once we break lower here, we have everything in an agreement as well. Okay, and I'm going to subscribe to the notion that you probably may have lost money here or missed opportunities. We're just going to call this a dead opportunity area where we didn't get any kind of reasonable um, positive equity increase. There was nothing that we profited from in here. Everything gets back in sync here when this candle breaks below this swing low here, okay, and then we have the high here is penetrated here. So now on this candle, everything's bullish, okay, inside of this overall sell framework. So what we're doing is what? We sit on our hands until when? Here, okay, we expect what? See this low here? What is that? That is a swing low. Again, the fractal indicator arrow is useful to communicate general support, swing highs and lows. But again, this is the reason why I don't like it by itself, because it will avoid printing an arrow where I would classify that as a swing low. So when the market opened up down here, market structure and order flow has shifted to bearishness again, okay? And this being the most recent swing high. As soon as this candle closes and this one opens up, this one would be a swing high to me. This is a swing low, and everything would be bearish here. Okay, and until that high is taken out on the upside, okay, or any newer swing high forming is taking out, I would be looking for lower prices. Okay, and the same thing happens here. We have the swing high because we have a candle with a lower high here and a lower high here. So this is a swing high to me. Okay, price breaks through it here. So now we have on a very short term market structure being bearish. Okay, I'm sorry, bullish. again, inside of a bearish framework. So we're looking to do what? We're selling into rallies. We're selling into it. Okay. So this is where you're going to be applying the what we commonly refer to as market flow or order flow. You will see on a daily chart many times rallies going against what would be considered market flow, being uh, bullish. In other words, this we have this swing high here. It's a candle with two lower highs on either side of it. When this candle blew up through it, we would be considered bullish daily market flow or order flow. But you have that range here that you got to work within. Okay, and that looks like this. You see how we went right up into that area here? Both candles stopped dead on the 79-cent tracer level, and then boom, it moved lower. Okay, and now we have everything back in sync again. We have this low taken out. We have both the framework on the moving averages suggesting lower prices, and the order flow and market flow is bearish because we took out the swing low, so everything's moving lower again. We will be continually looking for selling opportunities, okay, and inside this area here. Now again, we have the market creating a nice rally and reversal. Again, we are not trying to call the lows. We are not looking for the the tops and the bottoms in the marketplace. So even if we were to take a trade in here somewhere, okay, if something led to our analysis that we should suggest taking a short trade and we got stopped out, what do? We accept the loss and we move on. Okay, write it in our journal, keep it as a learning process, and continuously looking for the next opportunity. All this right here, okay, would be the same information this applied going forward. Now this, we only had these two examples in our analysis and study. Again, we had that red area and the two green areas. Inside of these pockets of price action, there's more than enough opportunities for you to take trades just using the daily chart. Okay, but if you use the 4-hour chart, you'll be able to glean a better understanding of what it is that you're going to be hunting. But before we do that, let's strip the chart again, and we're going to take these fractal things off here. Okay, and what I'm going to discuss now is what specifically is inside the candles that's useful to us, okay, and why consolidations breed opportunity. We have an area of consolidation right here, and I probably should take these rectangles off because there you go. And we have this consolidation right here. Okay, inside this, we're going to make it blue. In this little area here, okay, smart money is accumulating. Now, how do I know it's accumulating? Well, because number one, prices already moved off of an area where it caused a reaction. Okay, inside this reaction, this price move higher. Okay, we're talking about a daily chart moving for days to the tune of about 465 pips. Okay, retail traders can't do that. So institutional funds and institutional traders will. Smart money will. This is the elephant putting its foot in the water. Okay, then we go into a consolidation. It's pausing. In here, traders chase it, thinking, okay, what's been going up? I'm going to keep buying it, and they get pounded here, they get pounded here, they get pounded here. And at this point, they say, well, it's probably not going to keep going up, so I'm going to be a seller. And what do? They sell a breakout, okay, or they sell, whatever pattern they think is beneficial to them, and end up getting caught on the other side of the market again. We as traders, okay, here's what we're going to take a huge step right now, okay. You need institutional sponsorship in your trades. Institutional sponsorship is when you start seeing things like this. This market moves up, moved into consolidation. This is where pairing of orders is taking place. Okay, institutional trading is building up positions all in these areas here. Okay, and what you're looking for is where areas of where the market has moved with a great level of uh, conviction. Okay, if they can move the market almost 500 pips here and it starts pausing, chances are it's probably going to be another leg up. And what do I mean by that? Well, if you take this low to the high in here, if you see that range here, it's probably going to look to make a move equal to that same thing. Okay, and here's a low. We're going to basically use this because usually it's the same. This here and here is basically the same price. And if you take this out in time, you can see the market did move in fact to that same price level. Again, it's just like a measured move, taking the first swing and then consolidation and expecting another move higher. What I want to draw your attention to is, again, on the daily chart, how I like to view the market is, see this candle here? Okay, if we look at that, this candle right here, here, the body of that candle, okay, is to me the most useful portion of it. Okay, when price rallied up, okay, and consolidated and moved out of it and came right back down into it, but was unable to break this low, we are in a consolidation. Okay, in this area in here, okay, something's going on institutionally speaking. I don't know exactly what it is, but I know that there's something that traders on a large institutional basis want this price for whatever reason. They think there's value to it. Okay, and what we're going to do is we're going to be looking at this whole area here, and I really should be using the high of the candle, not just the body, but um, this whole area here is important because this is going to be an institutional order block. Okay, when price rallied out of that and it came back one more time, okay, they dipped it below this area here to clear out any kind of stops that would be resting there. Okay, and it's a stop run. One of the most important things you can have in your notes is if the price can come back to a key level of support resistance, sweep through it one more time, okay, and then fail to keep going, that's generally a sign that it was a stop rate and they're going to ready to do a major repricing going the opposite direction. In other words, contrary to the direction the stop was ran on. So in other words, they drove it lower here, engineered it lower to send it higher. Okay, why did they do that? Because they want the orders that are in existence down here. Okay, so what do I mean by that? Well, we had one little order block in here between this candle's high and this candle's low. Okay, when price rallied out, they couldn't get all their trade on. So what did they do? They stopped their buying. Okay, and with their not buying, price will be permitted to trade lower, and then they'll support the market again because why? Their buying comes back into the marketplace in here. Okay, and they're buying it up again. That's going to control this decline and keep it from going back into this area here because they already have established positions back here. They don't want those violated. They don't want to see a net loss in there, so they're going to add more positions in here, supporting the market. Again, don't think like a retail trader. Think like the banks, the institutional guys. They want to keep this thing. They have a vested interest in keeping this market up. So if they want it to move higher, they're going to be buying it at a level where they consider it valuable, okay, or a viewing perspective on the marketplace as it has a worth of some sort, or undervalued, if you will. Now, as price moved out of this area here, again, this is that consolidation area we just had blocked off. As price moved out of that area here, we have market structure shift here again to the bullishness. So this high was taken out here. So let's draw that out. Okay, we have our bullish market structure here. Price rallies up again, and then we have this decline. Okay, now remember earlier I was discussing that this, yes, it was 3 days where it was bearish. I'm not ignoring that. Okay, the reason why I was going to come back to this example here, because this is exactly what I use to get in these types of trades. If you look at this area of where the institutional order block was, okay, and again, How am I defining that? Because we went into a consolidation, we rallied up, okay, and you want to see a conviction, a very strong conviction in the marketplace. And when you see something like this where it moves several hundred pips, retail traders can't do that. So that's the elephant putting his foot in the water. And when the price comes back down, okay, and it gets back in that same area, we can reasonably expect to see it to do what? We expect it to rally. And when it rallies up and breaks these highs, we know that they are really putting an effort to keep this thing going, moving higher. Now watch, we're getting ready to take a huge leap forward, okay? This area here, because we used this first candle, it's the bearish candle, okay, prior to the first rally. If we took this down to a lower time frame, what do you think this is going to be? It's going to be a market structure or a market flow or order flow reference point where if it breaks to the higher side, we would expect to see what? Bullish prices, okay? But also it's during down candles, okay, or down moves is when the smart money accumulates positions. Let me say that one more time because it went right over your head, I'm sure. Smart money or professional traders do their buying on down moves. They do not chase price. They buy it when it's going down. Okay? When the market strong harms or smart money traders want to sell, they sell when the market's rallying up. They don't sell it when it's dropping down. Okay? So have that in your little notebook. You want to be doing the same thing, which is one of the strongest components that makes up my trading because I'm a buyer when the market's moving lower. If you were watching this series of 2 days here on an intraday basis, this probably looked like this was like a bat out of hell, okay, screaming lower, and it's probably going to keep on trading lower and lower and lower. You have to understand on this higher time frame daily chart what was taking place. See this whole area here where we blocked out? We have two areas of where they have created two large institutional order blocks. I'm going to show you the second one that took place. See the rally it took off here? The bearish candle right before it taking off is where you would have your expectancy of market structure shifting on the bullish side right in here. Okay. Now as price rallies off this low here, okay, and again, think this is a consolidation in here. So with this consolidation, there's opportunity being bred. Okay, and as the market moves higher, okay, it moves up in a rally, and again, you can day trade in these moves following that because this is a daily chart. So moving within this price swing, we can reasonably expect, you know, intraday trading opportunities, which is beyond the scope of this teaching again. But as price moves up and makes this price swing here, starts to retrace back in, we have two order block areas that may be utilized as retracement opportunities. Okay, you have this one here with this candle here, which is the first uh, down candle prior to the rally up in here. Okay, so above this high here would be the indication of a market structure shift on a lower time frame. So when it breaks above that, if it comes back down to that same point of origin, this will be a likely candidate for a buy. Now, what I want to draw your attention to here is the fact that we didn't get lower than these lows here really doesn't negate the validity of this potential area. It just means that they had enough of their orders established in this area here on this prior to this candle making this here. In other words, this down move here, all these candles moving up, breaking the swing high here. Okay, this is the first down candle. The high above this candle here, when it broke here, market structure on the lower time frames was bullish. Okay, so when we see that, price comes right back down, dips into the same order block here. Now it went a little bit lower again, but if we extend this in time, I'm going to illustrate what it is specifically that's going on an institutional level that you need to be aware of to help you with your trading. And I'm going to take these lines off because they no longer are serving a purpose. Okay, so price comes down, and again, remember these days here we were talking about earlier, if you know, as price ran up here, we were in that bullish environment where the averages were indicating that we were likely to see upward pressure. When price came down like this, we can sit back and wait for price to enter back into an area of potential uh, institutional order. So when we have price moving back into that, this is where we start understanding the mechanics behind the ICT optimal trade entry pattern. And let's take a look at that now. We have the swing here from this low up to this range high here. Okay, so we have the low here and the high here. Price comes down and slams right into that 70.5 level, or sweet spot, like I like to call it. That means you could be buying anywhere around that 130 big figure, not factoring in the spread. Obviously, about 3 pips is a safe bet. In this case, 130.06 or 130.05. That's a good number to try to get long in. The low prior to that, this swing low here, would be a possible scenario too. Had you were expecting this candle here, if it dipped down lower, we could have caught to 62% there. Okay, so I get a lot of questions on why I move my fib to certain swings and such, and now you're understanding really the mechanics behind it all. So let's look at the optimal trade entry a little bit closer and understand some central tenets to it and what's specifically the pattern really capitalizes on. When we have a market take out a swing high like this, okay, we have institutional sponsorship that takes the market above, okay, and when it returns back into an area of previous consolidation, we expect that to reposition or assume more longs. Okay, so in other words, they're pairing orders in here, they're allowing the market participants, okay, to see this quick drop down. Okay, and that's one of the things I find kind of interesting. When the markets are predisposed to go higher, they have these really one or two quick down dynamic days. Okay, and it kind of gets you all flustered and thinking, hey, look, this market's probably going to go lower. And if you're really sensitive to the lower time frames, like 1, 5, 15 minute, and even less than hourly in any capacity, it's very easy to swing your daily bias based on that. And if you learn to start looking at these daily and 4-hour charts, it helps you hold on to a longer term perspective, and you're less likely to be lulled into swinging back and forth on a daily basis. Your daily basis being bullish one day and bearish the next. And you can see really when these moves really take off, there are several days that they move. Okay, then you have a retrace, and then there are several days where it moves. Then you retrace. Then there's really dynamic, several dynamic days on the upside once it really starts to move out. When you find that it's fulfilled its order block, okay, you'll see that there's many times very little time for you to catch the entry point. So you got to know these things in advance, and that's why reacting to a price is not really the best case scenario. But as price moved down into this range here, okay, you can actually see in this smaller consolidation, okay, see this right here, this little area right here. Let's use this rectangle to highlight that. And what we'll do is we'll actually go down into a smaller time frame 4-hour chart, and we'll study that little consolidation as well. So we're going to assume for a moment that you were not privy to knowing this order block or institutional order area here. Okay, and as we moved into a consolidation in here, okay, what we'll do is we're going to drop down into a 4-hour. Okay, and you're going to see that same underlying pattern. We have a swing high in here, which is broken. Okay, I'm going to recap the pattern, what you're looking for. This is how institutional trading can be mimicked. Okay, you have an area of potential support, which we've already identified on the daily chart. Market ran up, made a swing high, came back and retraced. Now you can trade this with a pure understanding that's a support level, and this could be your retracement here. Okay. Now again, that's a 4-hour basis. You could do that, and the reason why is because you're using the same underlying premise that prior to this move up, the first down candle prior to it, which is here, if price returns back to that range as it does here, okay, and I'll drop a fib on that so you can see the mechanics behind it. Okay, you can see the 79% retracement level stops at dead to rights, boom, right there. Okay, and then price rallies up. In here, when we have this break here on a 4-hour, this is much more dynamic. When you see this take place, okay, put this in your notepad. If you see the overall pattern on a 4-hour chart break like this, and you're overall bullish still on the higher time frame daily, man, get ready, because it's going to have a dynamic price surge higher once we have a return back to the point of origin. The point of origin is what we discussed right here, and then when price moved up here, again, the first candle that's down prior to the rally up, once price rallies up away and breaks the swing high like we just discussed right here, we have this rally up, we wait, and when price returns back to this point of origin right in here, okay, this is where they dip back into that order block. Okay, so they had their orders here, they came back, they want to get an average fill around here, that 130.20, maybe 130.30 level. If you look over here, you can see that's the case. Price comes down, dips back into that order block again. Okay, they spend about a day or so in there acquiring more long positions. Okay, now what we'll do is we're going to use this swing low here up to the high here, okay, using that same range, and you can see the 79% retracement level right in here is containing the bodies of the candle, and there's only been 2 little wicks. Okay, and we're talking about maybe 3 pips that it violated the 79% retracement level. So if you were using just a 10 pip stop below this low here, and I don't want to get into um, stop loss placement yet, but I just want to give you a little hint as to what's going on. If you're buying in here at the 79% retracement level, and we'll just be fair and say you're buying at the 70 and 70.5, at the low here's 37 pips, and your stop to be 10 pips below that would be at 130.04. Okay, and that means you'd be risking, if you were trading just on the 4-hour basis, you'd have to have a stop of 47 pips, and that's still very close to what my average standard 30 pip stop loss is. So you can see how, by understanding this, we've already trimmed down a huge amount of the risk on a 4-hour time frame, not to mention what we could do if we drop down to an hourly basis and or 15-minute basis, which we'll do in a few moments. But just for the moment, let's just look at this again in greater detail. Price moves down into this order block based on this candle here. You can see it does not really jab down here and stab very aggressively. It just holds the 79% retracement level as we just noted earlier. So once price does this and it accumulates whatever it is that the institutional traders are trying to acquire, I don't have the insight as to what it is specifically they're trying to acquire, how much of the position they're assuming. I just understand the footprint that they leave in the marketplace. So when that takes place, okay, we know that it's most likely going to have an aggressive move up, okay, because we had the first run up here and then a 4-hour market structure break here, and then you wait for it to come back. Where's it going to come back to? This is your point of origin right here, okay? And it could very well easily come back into this one as well and create more or less like a double bottom. It rarely does that, and the reason why is because once it goes down, it doesn't want to usually come down much lower than that, because other institutional traders may get on board and drive much lower than that and throw off their targeted average entry price. So as they move up here, you can see, you literally can see it. There's a buying opportunity here. They acquire. Okay, it starts to move too much, so they settle down, relax, let price come back down again, dips back into this little area here. Okay, they buy more of it, and it rallies up. You can see there's much more aggressive buying pressure on this candle here, because it took 3 4-hour candles to make this range here, and then one 4-hour basis, boom, they took it up here, then come back, retraced, retraced, retraced. Where's it retracing to? The point of origin right here, and then all of a sudden the remaining block of trades that they wanted to assume for a long position was acquired here, and then they were off to the races. Now, just trading back to an old high like this, let's note that, and you can see, okay, looking for upward targets as like that. We're going to use this one first as an objective, as an example. There's 270 pips laid at your feet, and this one here. Again, we're going to assume you traded at the around the sweet spot. And again, there's 240 pips. So you really, would you be willing to risk roughly 50 pips, just trading on a 4-hour basis, risk 50 pips to make 240 pips? Does that sound like a good reward to risk? I'll leave that up for you to decide. But as price moved up, you can see it easily, quite easily hit this objective and then moved on beyond that as well. So with this example here, you can see how just simply waiting for these scenarios to set up, you can trade really a good number of pairs if you're trading on a higher time frame basis like that, because number one, think about how much time it takes to set these trades up. It takes a good bit of time. Also, it gives you an area where to anticipate and hunt these specific patterns. Okay, so it allows you the freedom to sit on your hands and wait and not feel rushed to get in there and just take a trade simply because it's something to do. So now what we're going to do is we're going to actually drill in tighter. Okay, and what I'm doing is I'm actually moving into this little pocket of price action. Okay, so this fractal here, we're going to look at in regards to a 15-minute. Let's go down to a 1-hour basis and see what that does first. Okay, now you can see price rallies up out of here, and right in here you can actually see how we're actually starting to fine-tune. Here's the bearish candle, the first one right before you go to the move up. So if you bracket that out, okay, you can see that's the order block in here. Now again, it's anywhere in here specifically, okay, but what I like to see is like a Fibonacci level and or pivot level in this area to suggest where price may be going. Also, I like round numbers, and in this case the 130.40 level is really ideal, and you can see that's also roughly the same price point this swing high is. Now also remember what we talked about when we look at swing highs, we like to look at the 3-bar pattern. Okay, here's the highest candle in this pattern. The right candle to the right of it with the lower high, its open and close and high and low is important. The open, high, low, and close on the high candle, or the highest most of the 3-bar pattern on the swing high pattern, and then this high here, the open, high, low, and close as well. So when we factor those individual price levels, you can actually take that out and extend it across in terms of like a horizontal lines, and really specifically wait for price to move down to those levels on on a 5-minute or 15-minute basis, and really fine-tune your entry in regards to what may be possible for trimming down the stop loss orders. So now what we're going to do is we're going to take the same price level here, okay, and I'm going to look at this small little section in price right here, and I'll make sure I'm not getting more than I want. Okay, right in here's what I'm looking for. Right there. And again, that's January 9th. And we're going to drop down to a 15-minute time frame. Okay, and now watch. We have price action, okay, in here moving up on a very short-term basis, okay, and comes back down. See this candle here? That's your point of origin where the rally ensues, right in here. You move that out in time. Right in here, price comes back down into it and then runs up, okay? Same thing here. Okay, we have this rally here. Here's the candle prior to the rally up. It's bearish. And if you take that area here, you can see it enters that order block again, right here. And again, if you run your fibs on that, okay, you can get opportunities where you can take intraday trades and get in sync with the higher time frame trades as well. But assuming that you took that as your entry point based on the higher time frame trade, okay, you could trade this here. Okay, maybe get in at 130. Let's see, what is that price? Is 130.45. Let's say 130.47 is fair, and you're using a 10 pip stop below here. Actually, gotta crunch this up just a little bit so you can see where the stop loss would be, and you can trim back the risk. And again, assuming you're getting long on a limit at 130.47. And we're going to use this low here as your primary reference point for stop location. If you go down 10 pips below that, your stop loss order will be at 130.27. Okay, and what we'll do is we're going to put that in here, 130.27, and price comes down but never comes close to it. Okay, I mean, scrunch it up, you can see it. So you can get yourself positioned here. Okay, and again, this is a 15-minute chart, so you're waiting for these positions to unwind. Because remember, we're looking at a 4-hour and daily time frame setup, so you're not trading it on a 15-minute basis. So when you start seeing these wiggles lower, where's your stop loss? Down here. So you just simply let it do its thing, and price rallies on up, and you get excited, and everything's, you know, as you'd hoped it would be. Okay, you can see the point of entry back here, and then the ultimate unwinding of that position here. All right, let's take a look at another example, and we see this price rally up off of a daily chart, key support level down here, and what I want to draw your attention to in here is obviously this quick rally up and then a bull flag formation in here. We have this level in here. If you were following any of my market reviews, we talked about this level being a possible area of support. And prior to the move out, okay, we had a couple different areas that could have lent to probable areas of support and institutional dealing ranges where order blocks may reside for the institutional level trading. And that comes in the form here. We have this candle here prior to it to move up. Okay, in other words, this move higher, and this candle here. Okay, and you can see that's the first bearish candle prior to the move higher, first bearish candle prior to the move higher, and we see also this likely support and resistance level based on this intermediate term high on the daily chart. We did get an opportunity to see it bounce here, okay, and that's seen with this move here. This was the bearish candle prior to its rally up. So if you take the range in here, you can see how this retracement would have been a very decent, handsome opportunity to get along on. Price came back down to that same institutional order block in here and rallied up higher and eventually started to break down. Okay, and let's take a look at what transpired here. We lost this level here. We started trading lower. Okay, and this would be the next area to expect some support. Okay, and you can see price trades right down into that right there. Okay, now what I'm going to do is I'm just going to take a horizontal level, draw it across the chart like that. Okay, and when you see this, this is an area where to reasonably expect prices to bounce. If you notice also the low here to this high, this is your price swing. You see that? Okay, we're retracing inside that price swing. So if you take the range and highlight that with your Fibonacci tool, you can see the sweet spot lays directly right on top of that same point of origin right in here. Price does not move much lower than that. Again, this is a daily chart, and price rallies on up. And price rallies on up. Okay, so you can see that there's a definite advantage in knowing where the institutional level trading is going to come in to the marketplace, and by having an understanding of where that's going to take place, you can also expect it on a time basis with the kill zones. Okay, so we have an understanding of support resistance, we have an understanding of the time of day, we understand where the big moves should ensue and where to more or less wait for them to to take place and form based on a higher time frame charts. If we look at the market on a shorter time frame, okay, and we're going to apply our tools we learned for the directional bias, okay, and the 18 period. Okay, and what we're going to do is we're going to look at a time frame when price was moving up in here. Okay, and I'm going to highlight that with a little rectangle in here, and what that's going to help me do is show you how to use this for trade entry. And what we're going to do is we're going to break down to a 15-minute time frame to do that. Okay, what I did was zoom down into a 15-minute time frame, and I added the Asian range for each daily intraday action. And what I'm going to draw your attention to here is as market moves into, this is a Monday, okay, it's very hard to see here, but this is a double line delineating a Sunday. Okay, and we're just going to scroll through, and here is a Monday, and going into Tuesday. Here's Tuesday's trading here. Okay, now looking at this, you can see how price moved up here and created a range here. See this down candle prior to the move up? Okay, we had this rally up here. If you take your fib and you pull it from a swing low here up to this range high, price comes down to the 62% retracement level, and this is 9 GMT. This is the London Open. Okay, so there's an opportunity where being long, okay, and now with the background being blue like this, again, what that's highlighting is a time period when on the daily basis we have the 9 period exponential moving average above the 18 period. So we have institutional momentum on the upward side of the market. In other words, we're looking for just buys. The framework is established as a bullish scenario. So we would be looking for opportunities to be a buyer here. And that's one example here using what we just discussed with point of origin here, and when price rallies up and trades back down into it, we see price move up into its high for the day, and now we have another right here. Okay, we have this range here and trades down. We're going to use, this is the first down bearish candle prior to the move higher, so we're going to use that as its basis. Okay, right in here, and we have this candle here prior to this move up, so we could use that one as well. What you're looking for is clear points of where price moves with conviction, okay, where it's really clearly trying to move away. You have it here, okay, and then you have it here. Again, this is a 15-minute time frame, and then price makes its price swing and trades lower. This candle on the very low here is 15:15 GMT, so that's like 15 minutes past um, the kill zone that this was established for this trading series. This here is 15 GMT, and this is 14:45 GMT. So this is still a capable trade setup for the New York open session. Late for New York, but still nonetheless, it's something you can take a trade on. Let's go out one here. We have just in market structure alone here. This is nice, where you have a low, a lower low, two of them in here, and a higher low here. So we have an intermediate term low just in market structure alone. So that's bullish by itself without anything else added to it. That's very good. And then we have price rally up away here. This is our first bullish candle prior to the move up. Okay, you can see how it rallies up. This is your range. Put your fib on that range. Right in here. This candle here comes in at 9 GMT. This candle here is 9:30 GMT. That's London Open. Okay. We also have this rally here, and then it comes right back into, here's the first bearish candle prior to the move up. So this is where the market structure would shift. Okay, and without having to draw a line, you can see we move back into that range right here. Here is the smaller reference point. Here's where you would be buying, and again, a 10 pip risk below here. Let's give you an idea what that will look like in terms of, again, we're going to say we bought at the 70.5 level at 131.07. Here's the low, and if we go down 10 pips below that, your stop would be at 130.86. Okay, so approximately a 30 pip stop, well within the range of probable. And trading back to an old high, you could take profits here, or just look for it to continue moving on a higher basis. Okay, you can see price moving up here. Now, just let's zoom in here, and I want you to see, using the ideas that we just covered. Okay, look at every time when the market moves up, breaks a swing high, okay, then comes back down and comes right back into that previous point of origin. In other words, this is where the move starts and trades right back into it. This is what you pull your fib on. Okay, I get a lot of questions. What am I looking for? Why do I put my fib where? Why would I use those reference points like you do in your videos? Well, if you go back over all of the videos you ever see me doing it, you'll see me doing this very thing. Okay, and here you go. We have price moving up here. Okay, this is a Monday's trading. We have the first bearish candle prior to the move going up. Okay, take your range, draw it out over here. Okay, when you see that here, this candle forms at 6:30 GMT. Okay, 6:30 GMT. That's about a half an hour right before um, the very beginning of what I like to see in terms of the, the meat of London starting. You can see how it comes right down to that sweet spot in here. Okay, and also note, and I probably should have said this, I'm jumping ahead of myself. When you're looking to be a buyer, you want to be doing what we mentioned earlier in the previous video, using the Asian range high as your filter. So in other words, you want to be buying definitely anything below this level. Okay, it's an ideal position entry point. Again, here we have the Asian range high. This is below the Asian range low, so that's even better. Okay, and here is the New York session buy, and again here's the bearish candle prior to the move up. Okay, and if you look over here, you can see we move right back into that point of origin. Okay, so they moved right back into that dealing range and order block. And if you use the low in here up to here, you can see how we went right down to the 79 saturation level and moved up rather handsomely. Even if you used the low formed in London, you're still getting almost a sweet spot here, but certainly this 62% retracement level, and getting in sync with the daily trend. You can see how that's rather handsome in terms of a trade opportunity. Okay, and again we have this point here where we have a New York session low. Remember, we're looking at session highs and lows, not just previous days highs and lows. And here is your bearish candle prior to the rally up. So you're going to see market structure shift on this candle. Draw that out in time. Okay, because this is the point of origin where this rally took place. So the range that was created here originated right here on this bearish candle. So when the market structure broke here, this is where the order block resides. Okay, within this candle, this is where the institutional order block resides. Okay, so when market meanders and trades lower, where does it go back into? That same order block, and then they acquire more of the original position they were trying to acquire here that they couldn't get on because the market started to take off. And if you take that and you add that to your fib, okay, you can see how here's the 79 concentration level deviated just a little bit, and we're going to give you actually how much it moved below it to give you an idea how much. And we're talking about 6 pips, and I think that's livable, guys. You guys can certainly tolerate that. If you were to use the lower low here, you still end up with the sweet spot. Okay, so you can see how using session lows and highs, with the directional bias defined as we just covered in this video, it really helps you ferret out opportunities, and certainly being a buyer down here below the Asia range high. Okay, think of the daily range. Remember, we were talking about the likelihood of big range days. If we have the opening price in here, okay, it doesn't really work both sides of the opening price very much, and certainly doesn't work the lower end making the low very much. In other words, what do I mean by that? There's not much range on the daily bar from the opening to the low. Okay, and let's see what that does here. Okay, we're just going to eyeball it, and we're talking about 27 pips. Okay, 27 pips. So it worked lower 27, but moved off of the lows for the day to the tune of 76 pips. So it's basically 3 to 1 almost. Okay. The the reoccurring principle is simply looking for retracements in an uptrend. Okay, so you're buying dips in an uptrend, and if you look at we go here. Here's one where it was not able to get down into that price point in here. But using just the optimal trade entry, you can see how we got a sweet spot here. And I'm sure if you pulled the pivots up, which we're not going to do here because I'm trying to keep this video around 3 hours at maximum, which is a lot by itself, but nonetheless, it's certainly it's certainly a long video. And here's you can see opportunity in here where you could have even intraday, price when this rallied up like this. Here's your first bearish candle, went right down into the order block right here, and then gave you a tradable rally. Okay, and let's just look at that range. It's 44 pips, so that's certainly something you can get 20 pips, 25, 30 pips out of. Okay, and let's drop out one more. Here's a nice double bottom where it comes right back down to this original order block prior to it rallying up. Market moves into consolidation in here, and really don't have anything that's really discernible. So you may be sitting on your hands in here. Here's one that was this was all right. You got this candle here, draw it out in time, it moves right back into that same order block and it moves higher. Again, all we're doing is focusing on the buying, not anything else, just simply looking for buying opportunities. Okay, we have prior to the move up, we have this bearish candle here, draw that out in time. Okay, and pull our fib on the range. Here's a 79-cent retracement level in here. Deviate just a little bit below it. And this is where you would have encountered a trade that would have been a losing trade. Okay, and it's fair for me to show you this because I don't want to just go through and appear to be just cherry picking, looking at the opportunities where it worked out favorably every single time. Because I don't want to lull you into thinking this is going to be perfect and it's not going to give you any losses. It certainly would have happened here. Here's one where it moves deeper below it and runs the stops on the Asian range low before running higher. We have the same scenario here where the previous day's low, which in this case is 14 GMT, which is a session low, New York session. Here's your low to high, the range. Price drops down into the 62, almost the sweet spot, returning back to this dealing range and institutional level point of origin where everything, when price dropped lower, it allowed them to accumulate more of their long positions, and then you saw the price move on up and profit release portion of the trade unfolded. We have another little opportunity in here where price moves up, first bearish candle in here, draw it out in time. This is a return to the point of origin, back into the order block here, and price rallies up. And this candle here comes in at 1600 GMT. Nice little opportunity to be able to catch a scalp intraday. And I'm only tossing this in, that's about 40 pips or so in terms of pip range. I'm adding these intraday setups to show you how you can use it to be a trader on an intraday basis or a scalper. But really, what you want to be focusing on is the ideal days of the week, which are Monday. I'm sorry, yeah, Monday, Tuesday, and Wednesday being the higher low of the week. And again, because we're looking at this um, area of price action, we're going to look for, again, just the significant lows to form for the week on. Let's go back and look at the beginning portion of that. And just for clarity, because I want to make sure that this is easy to see. I'm just going to change the color to a little lightly. There you go. It's a little bit easier to see. Here's Monday's trading, and that's the low of the week during the time when we're looking for buying opportunities only. Okay, so on Monday this week, we have the Monday making the low. On this week here, the low of the week is on Monday as well. Nice opportunity to be buying on Tuesday, even gives you an opportunity on Thursday, which doesn't fit the model, but still everything working towards making a higher close on Friday is the general idea. We have a shift in market tone in here where it went lower and retraced much deeper, but there were certainly buying opportunities on Monday, Tuesday, and even on Wednesday, still catching some opportunities to be a buyer. The low on this week comes in on Monday. Very nice opportunity to be a buyer here as well. And you can actually see this same result of here's the down candle prior to the move up, and it retraces back into that order block. And there's your optimal trade entry, moving higher. And Tuesday, opportunity to be a buyer. Wednesday, nice opportunity to be a buyer. Okay, those are those one shot, one kill type scenarios that you would be looking for to not trade a whole lot, but catch very handsome pips and not have to do a whole lot of work really. The low actually forms here on Thursday for this particular week, and again, I'm using the double lines here delineating the marker of Sunday to Sunday. So the action between those two is the intra-week price action. Nice buying opportunity here on the Monday of this week. Nice one on Tuesday. Okay, does retrace, trades lower than Monday's low, but again, still opportunities to be a buyer, moving up rather handsomely. And we move into an area where we no longer have the daily bias in force, where now we would be expecting to see lower prices come into effect, and that's what you see here. And really, if you just reverse the scenario and look at everything like we just did on the buy side, reversing it for the downside, it's much in the same capacity, the same thing, just reversed. Okay, and let's take a look at the breakdown of what you're looking for with the support and resistance notion and the time of day and the optimal trade entry, and what specifically that sets up your trade that deems it as high probability. Okay, the ICT optimal trade entry pattern. The premise really builds upon the understanding of support and resistance, and we're going to use this example here to illustrate the example of an optimal trade entry that's used for a buy entry. And assuming that the support level has been arrived at, we have this support level, which is ideally a higher level daily 4-hour or 1-hour time frame support line. This high here, okay, this swing high breaking this previous high is good. That's what you want to see. Okay, and then when you have price break it again here, you have another more or less a conviction by the traders that are in control of price, which are smart money. They are indicating to us that they are wanting to see this market not trade lower. Okay, so if it's not going to go lower, chances are it's probably going to go up and go up sharply. Now, if we see the star here that's delineating a break in market structure, okay, on both points, the previous little short-term high that we just showed, and now when the price ran up aggressively through that, what we would be waiting for is price to return back to the point of origin. That's seen here, where price comes right back down into the first bearish candle prior to the rally up, okay, breaking market structure here. So now we have a range from here to here, okay? So we're looking for price really to stay above support, not necessarily trading back down to that same price level. This is the swing that you should be identifying with your eye. This is what you train your eye to see. This particular price swing is what's necessary for you to pull your fib on. By doing that, and again noting where the market structure has shifted, when price moves back down into this area here, it's between the 62 and 79% retracement level. The 70.5 level is what I deem the sweet spot. That's generally what I try to aim at for my entry point. I may add the pip spread from that point, or I'll use the 62% retracement level, depending upon the type of pip range between the two. If it's not a whole lot, I'll just simply use the 62, so just to make sure I get the trade, as long as it doesn't deviate my overall price um, parameters in terms of allowing my stop loss order to be within my maximum risk per trade. And obviously you can see the results of taking this type of pattern with the understanding of everything that we've talked about in this video series up to this point in that little gray, in that little green box. Ideally, that should be a kill zone, be it the London Open or the New York Session Open. Okay, those are the ideal trading scenarios for you to be finding trading opportunities to get long in, and again with the assumption that the 9-day exponential moving average is above the 18-day. And when you have that, and also order flow and market flow and market structure on that time frame, daily and 4-hour, are suggesting higher prices, it's all but a green light just to get in there and start hunting buying opportunities using this format.